Hi there, and thank you for joining us. The topic of today's video is mortgage rates. They're rising. My name is Peggy Fitzgerald.
I'm Jay Epstein.
And we are the Fitzgerald Real Estate Group at Keller Williams in Newtown, Pennsylvania.
It's our pleasure to introduce Mark Keller, Senior Loan Officer with Huntington Valley Bank, a trusted name in mortgages for the last 27 years.
Thank you, Peggy and Jay, and thanks for having me. Today I'd like to speak about interest rates, where they were just a short time ago, where they are currently, and where they're projected to be in the future. When COVID first began over a year and a half ago, the Federal Reserve announced to stimulate the economy to increase their purchase of mortgage-backed securities and treasuries to a tune of $120 billion additional each month. That's broken down into $80 billion in treasuries and $40 billion in mortgage-backed securities. With the Federal Reserve doing that, it did stimulate the economy and drove interest rates down sharply of over 1% within that time frame. Going forward, the economy is now recovering. Unemployment rates are close to pre-COVID levels, and the Federal Reserve had made a statement that they are going to be tapering the purchase of mortgage-backed securities and treasuries to a tune of $1 billion in treasuries, or excuse me, $10 billion in treasuries and $5 billion in mortgage-backed securities each month, purchasing less. With that announcement, interest rates did jump up slightly. So let's take a look at an example of where the rates are. So on a $300,000 loan, a year ago, the approximate interest rate was 2.75%. with a monthly payment of $12.24.72. Currently, the average interest rate is 3.125, which is a 3/8 increase in just a very short period of time, making the payment $12.85.13. That's a $60 increase. With the Federal Reserve tapering the purchase of mortgage-backed securities, it's estimated that rates will jump to at least pre-COVID levels at 3.5%, making the payment $13.47.13. That's $122 a month more than what the rates were just a short time ago. I don't know about you, but I most certainly would rather have the $122 in my pocket than in your mortgage payment. So what does that mean to a buyer? So if a buyer was pre-qualified at the lower interest rate, and it increases, making the payment $122 more, and they don't qualify for that higher payment, we would have to either buy down the interest rate to that level or reduce the loan amount by over $27,000 in their purchasing power. So I guess my messages today is most certainly do not wait for the higher interest rates. The time to purchase would be now. Thank you so much.
Thank you for joining us. We hope this information was of value to you.
And if you'd like particular information regarding your own personal situation, please do give us a call. Our contact information, whether it's from myself, Jay, or from Mark, is streaming below.
Thank you.